All right, everyone. Chris Lopez here, and welcome back to another episode. This interview is another interview with a book contributor, or I should say a contributor to the 2020 Guide to Denver Real Estate Investing Strategies book. So my co-host today is Joe Massey. Joe, how's it going?
Fantastic. Great to see you today. I'm really excited with our guest today. He is one of our esteemed colleagues, just a terrific guy. Always fun to chat with him. He has terrific stories, terrific information. Just really enjoy working with him. He's a pleasure to work with as a client, but probably even more fun just to work with as a collaborator on house hacking, on the upcoming house hacking book, on the book here, the 2020 Guide to Denver Real Estate Investing Strategies. Just cannot say enough positive about our good friend, Mr. Jeff White. Jeff, how's it going today, man? How are you?
I'm doing well. Just enjoying this last moments in my room here before I'm fully moved out. Solely empty. It's kind of weird, but it's my little office, lonely office over here.
I mean, let's just, you kind of put the cart before the horse on here. Let's talk about this because, normally what we do with these interviews is we talk about kind of like a recap of what your goals are, and then also how things have changed, post-COVID or, during the current COVID pandemic. But you already kind of mentioned one of your goals for 2020 was to purchase your fourth house hack. And you just leave the fact that, you said like you're literally like this is your last day and you're in house hack number 3, right?
Yeah, literally moving out the rest of my office equipment and this little foam roller over here. Right there. And then I'll be all set and ready, fully moved in. Technically moved into the other place, but this last little bits. That was one of my big goals for 2020. And with everything that's happened, that, nothing changed that goal, because I think real estate is such a terrific investment, long term and also short term, but more so long term. And that I'm so happy to have the opportunity to purchase a fourth one. So thank you, Joe.
Hey, you know what, man? You're doing it all the right things. You buy a property, you move into it, you house hack it, you save up your money, you live there for that 12 months or a little bit longer, and then you go out and you get on the market or get on the MLS and find the next deal that's on the market. And you just do it over and over again, man. I think you're a true testament to success and testament to setting goals and achieving them. So let's talk a little bit about that. Your real estate strategy, your goals, give us kind of the high level. What's your goals for how many properties do you want to own? Where do you want to go? As far as, do you want to own one property, 1,000 properties, 10 properties? Give us a little bit of high level detail there.
Yeah, I guess I look at it more split between house hacks and investment properties. Mm-hmm. So house hacks, I think we talked about this before. I want to hit 8 just to be one more than the person that you said was the highest.
Nice.
And for you. And then for investment properties. Oh, go ahead.
I got to interrupt you. Just give everyone context here, because during in April and May, the three of us recorded like 15 podcasts for just the ultimate house hacking guide in Denver.
Yep.
And one of the things Joe mentioned was that, we mentioned, hey, people get house hack fatigue.
Yep.
I think you said your client with the best record was up to 7 house hacks.
Yep.
So Jeff has to outdo him or her by 1. That's why Jeff is going for 8. So that.
Hey, you know what? I love it. We're gonna get 8 new properties. I think that's a terrific goal. Whatever it takes. So
let's not worry about income goals. Just gotta beat the other person, right?
Perfect.
Yeah, just for fun. It's just fun. I look at it. Well, I think that's a big part of it too. Is I have my goals for number of properties. It's more, I don't really look at it less number per se and more net cash flow with a property manager. So I look at it like that. So basically, if you look at it that way, my net cash flow goal with a property manager would be approximately $8,000 a month.
Okay. And which equates to roughly 8 properties generating $1,000 a month each. And this is prior to them being paid off. This is still, they would still have mortgages.
Yeah, okay. They all still have, still have mortgages, still set aside for reserves and maintenance and vacancies and all that as well. So that's the net cash flow number. That's what I look at. Yeah, because if you because sometimes if I just said, I want 10 properties, that's kind of like, well, is it 10 investment properties, 10 house hacks? Because if there's only investment properties, then that'd be what, best case scenario, I bought only condos, maximum $500 a month cash flow for each one,
Right.
then that's $5,000 right there. But if I said house hacks, then it's a completely different number. And then combining the two, even better.
Yeah, I think that's such a terrific point for our listeners out there. And I have a lot of people that come to me and they say, oh, I want to own 10 properties. Okay, great. Well, Jeff takes it a step further. He wants to own 10 properties that generate an average of 8 properties that generate $1,000, an average of $1,000 per property. And he's not trying to do that by August, right? He's got a long-term plan. We're going to do this over a period of 8, 6, 10, 12, 4 years, whatever the number is. It's not something he's trying to accomplish tomorrow. And talking about that cash flow is so important. I kind of pick on people every now and then, like, well, I want to own 10 properties. I'm like, cool. Are you good if they all lose money? Well, no, I want all of them to make money. I want cash flow. Okay, great. So let's take this evolution a step farther. How much money do you want to make per property? And Jeff, you've thought through it. And I think that $1,000 per month per property is a great goal and really helps keep you focused that it's not just, I want to have 8 properties. I want to have 8 properties that are making money, and I want them to be making an average of this much money. I think that's really smart. Chris, what do you think?
No, I like it. And one something we don't talk about a whole lot because we always talk about, getting those properties and paid off. But what you're setting yourself up for, Jeff, is you get those 8 properties, netting $1,000 cash flow, while you still have a mortgage debt. The great thing is you are still getting that cash flow now, which what I know about you, that should be enough for you to be able to, quit your job off if you got that cash flow. But then you're still giving yourself a lot of runway for delayed gratification. Because as those properties pay off, whether it's just the natural payment through the 30-year loans, or you do some prepayments, or you sell a few and 1031 and trade up, like you'll be making $8,000 here in the near future. But when those are paid off or you trade up, that'll probably be like $20,000 a month because you're really like delaying your gratification on there as well.
Yeah, that's going to be a great retirement plan. In addition to, one of the things I love about your strategy, you do other things, right? You've got stocks, bonds, your 401k, all these other miscellaneous things that are going on. This is just one piece of the investment puzzle. I really like that.
So let's talk about your 4th house hack, because this, you got another home run here. So I'm just going to read from your chapter here in the book. Under goals for 2020, I will purchase my 4th house hack with conventional financing with a 5% down payment, with the goal of $700 to $1,000 a month in net cash flow after maintenance, vacancy, and reserves. House hacking criteria: single family house, 6 to 7 bedrooms, 3 to 4 baths, 2,800 square feet, near retail, restaurants, schools, parkways, public transit, and seeking a greater than 20% cash on cash return. So number one, Joe and I talk about this all the time. You have very, very defined criteria.
Love it.
So every investor out there, take notes, because for those 2 sentences and 5 bullet points, that allows us to go out there, help you find the property, exactly what you want, and you acted fast on this property, Jeff. But tell us, how'd that play out for you? You wrote this goal. What'd you end up with?
I actually ended up with a 10-bedroom, 4-bath place. That's 3,300 square feet. So it worked out even better than I could even imagine, because I put those parameters to really define it, so I know I don't waste time like at the 4-bedroom, 2-bath houses, or like something like that's just a waste of time. So I just aim high, and then sometimes you hit that home run or the triple, and then you're like, sweet, even better.
Mm-hmm. I love it. So I love the fact that you have that defined criteria. And I think as of today, we can say this goal has been accomplished. You can check it off your list, right? Because your property meets all these criteria. You're done. You said today's the last day in the old house. You're moving into the new house this afternoon, right?
Yeah, literally. So
that's great,
grabbing up the rest of the stuff. And so happy to accomplish it, because I know there's a lot of people out there that, I know some investors get a little more creative, and Joe could probably speak on this, where they don't capture it in their tax returns, collect cash, or write off too many things, and then they can't qualify for the next one because their debt to income's all messed up. And then that's where I try to do everything very straight. Everything's recorded, verifiable, and keep track of especially with all these tenants, you really got to be organized, because if I wasn't, then it'd be a nightmare trying to follow up with people and saying, oh, did you pay half the rent or what did you do? So
Yeah.
You know, that's a good question. So you have 4 house hacks now. How many individual tenants, individual people that have signed leases with you?
so at the moment, it is 13.
13. All right. So you're
Yeah.
like, you're running your own little property management business
Yeah,
too.
exactly.
But you know what? I
And
think
then
that's
after,
go ahead.
yeah. Oh yeah. Then after this one gets all stabilized, it'll be another 5. So 15 or sorry, 18, excuse me.
18.
Yeah.
So I want everybody to think about that for a second. I really love what Jeff said. He takes the information, it's verifiable. He saves the receipts, saves the leases, saves the you know, the deposits that come in through Venmo or PayPal or whatever, you know, particular service you use, or via check or cash or whatever, records that. I'm sure you have a spreadsheet somewhere, and it's probably extensive at this point on each property, each room, who's the tenant, when is their lease up, et cetera. So it's important to stay organized with that stuff for 2 reasons. Number one, when it comes time to get the new loan from me, Jeff is great. He forwards over his email. I go through it. Yeah, this is terrific. I have like 1 question. But more important than dealing with me, the lender, he's got to deal with all these tenants every single day. And so this is a great thing that I would have never thought of. He's managing 13 to 18 tenants at any given time. He's got to have a system to manage them, or else ultimately he's going to miss rents. He's going to miss out on something. He's not going to keep the property updated because somebody said, hey, I broke X, Y, Z, and he's going to forget to go out there and maintain it. So I think this is a very eye-opening for me, Jeff, and I love it that you've got this many tenants, and I'm sure you've got a great system to organize that. Tell us just a little bit about that. How does that work?
Yeah, I mean, basically, it's you know, my background's finance, accounting, so I love spreadsheets, just like Joe does. And so I just have a separate spreadsheet for each property that details every single room. That's so basically, like it all it's like the detail section and the summary section. So it's down every single tenant or roommate or individual space that's rented out, and then all the expenses every month, all the like anything I fix up. So I have everything ready to go for Joe, for my tax accountant as well.
Genius, really smart. It would have, again, until you mentioned it, I would have never connected. But again, that's one of the reasons that you're one of the most successful house hackers in Denver, why you're a very successful property investor. You're keeping organized. You're running this like a business. Because
Yes.
this is a business, right? This is Jeff White, you know, realestateinvesting.com or whatever you want to call it, LLC or incorporated. This is the Jeff White business to make money and eventually retire. I love it, man. You're taking it serious. And I think this is a great testament to what you're up to.
And something I just want to mention this because it's something that 3 of us have been working on now here for a few months is that, you know, Jeff, just because you've done such a great job of like, you know, stabilizing your house hacks, running things room by room. You know, we got plans on getting your help on helping to coach some other house hacking clients to do what you want to do, and kind of, hey, here's the model, here's the spreadsheets, here's the systems, here's a checklist I use.
Yeah.
So if listeners out there, definitely reach out to Jeff, or another, you know, month or two, we'll have a much more organized information out there as well. That's what I'm excited to kind of work with you on to help other house hackers out there, because you have got just a dialed in system for that.
Yeah. Tell us just a little bit about that, Jeff. Chris hit a lot of the points, but I want to hear from Jeff. Give us a quick 30-second, 1 minute. What are you going to be doing with your house hacking coaching program?
Yeah, basically it's just to help newbie house hackers on their first one, third one, second one, doesn't really matter. But basically they just want help and assisting to maximize, not only maximize rents, but just make it a long-term successful investment vehicle for them to build wealth long-term.
Love it. Love it. And that's personal. You're going to provide workbooks and spreadsheets and stuff, but they can work personally with you as well, right?
Yeah, it'd be a combination of, you know, access to all the spreadsheets and information and guides and checklists, and then also personalized coaching or any like certain packages will give you like 6-month, you get email questions or get one-on-one phone calls and assistance, and just adding as much value as possible to where the person is set up for the long term.
Love it. That's awesome, man. That's awesome. So tell us, or you go ahead.
Okay, I was going to say, because one of your other goals in here was talking about just purchase your first investment property. So a non-house hack, 20-25% down landlord property. Has COVID changed any of those plans on buying another property this year for you?
No, it's actually, if anything, it motivates me to get another property because I can anticipate with all the high unemployment and, if this drags out more months, then we'll have more swings in the economy and possibly even more unemployment again. There'll be way more renters. So if anything, real estate, I think, is, especially in Denver, just a terrific value play because the renters will be there. The numbers still work, especially when we're talking about more of your favorite type of investment properties, which is what, 3 Tucos in Aurora that you guys like.
Yeah.
From a numbers
cash
point of view.
flow well.
Tough to go wrong with those.
Yeah.
So what, speaking of COVID and stuff, because I know we caught up right as COVID hit, but now we're around 3 or 4 months into it. I haven't actually talked to you in a couple months about this, but how are your current renters and properties performing?
Ooh, that's a good question.
Yeah, so just give you some numbers. I just know offhand. So I had 4 tenants that lost their jobs, and 2 of them are on payment plans, and I've collected about 90% of all my rents, and then the 2 that are on pay plans will eventually get caught up. But yeah, it hasn't. I thought it'd have more of an impact, but luckily my tenant base is pretty spread out in the sense they're all one industry. And on top of that, not only is my tenant base not in one industry, but I also do rent by rooms, and renting by rooms, it's a lot more affordable than if I, House Islands renting for $4,000 a month or something. Like if that tenant lost their job, that would be hard to afford that rent. But paying, $700, $600 a month for a room, people could swing that, especially with unemployment in Colorado is really good. And then that federal $600 a week as well. I know that helped a lot of people as well. So actually, yeah, so surprisingly, it hasn't impacted my real estate business as much as I initially thought it would back in March.
So overall, you said 90% plus on all your rents collected.
Yeah, correct.
Yep. That's great.
Yeah. I think that's, again, something that I would have never thought about. So you mentioned it. What a great point about house hacking, right? If I'm renting a house in the Highlands for $4,000 a month, that person loses their job instantly. That $4,000 a month goes away. But you're renting 4 bedrooms in a house, $700 per bedroom. Hey, one person loses their job and they say, hey, you know what, Jeff, I can't pay. All right, you're still getting income on the other 3 bedrooms. Or maybe that person says, you know what, Jeff, I can pay, but I can only pay half. Or, hey, I want to go on a payment plan. Or, hey, I'm getting unemployment and I'm going to be able to actually keep up with my payments because it's only $700 a month. It's not $4,000 a month. What a great way to spread your risk out. I never would have thought about that. But you're basically, the rental income coming in for property A is not dependent on one single wage earner or breadwinner. It's spread out. That risk is spread out, which is going to levelize some of the volatility. I think what a great thought there. I appreciate that information.
Yeah, it's just something to think about because when I was talking to a friend, I was like, oh yeah, actually it does spread the risk because like I could have every single person lose their job or make half the payments. And then, that hurts, but it won't kill me as much if I had one tenant and that one tenant lost their job and couldn't make anything, I got 0 or like 25% of it. So that's where the reality is, people lose, like, especially a couple of my tenants work in the restaurant industry, that hurt them a lot those few months. They're still hurting them now. But they, to swing $700 is a lot easier than if that rent was $1,500.
Yeah. Cool. Really neat.
Yeah.
So this is kind of, I'm going to read something else from your chapter that I want to kind of have a debate with you guys on here. So this is, under savings, spending, and reserves. You say, currently I'm saving close to 60% of my monthly W-2. I have no consumer debt, no car loans, no student loans, just mortgage debt. But I'll do better this year by eating out less to achieve a 65% savings rate.
Yeah.
And so kind of what I've noticed about myself is that, hey, going from a 60 to 65% savings rate, I don't think is going to make or break you based on what I know about you. Hey, the extra money on there, hey, well, it's great. I don't think it's gonna be like a difference maker. And I take the attitude like, hey, that's such a small amount. I'd rather put my focus on not saving that towards versus like buying another asset. Like, hey, another, like your new house hack, house hack number 4 is going to give a lot more wealth building aspect than like eating out less in my mind.
Right.
So how do you debate, how do you in your mind, like focus on like, hey, the smaller stuff versus, hey, the big stuff, which is, hey, if I buy 1 or 2 more properties this year, this has a 10x impact on my retirement down the road versus eating out 5 times less a month.
Yeah, that's
Like,
how I look at it.
Do you track that, or how do you? I'm curious from your financial mind how you analyze that.
Yeah, I look at it, especially I'm getting the great benefit of living for actually making money while living at a place. I mean, how sweet is that? That's getting paid to live in a place versus paying rent or a mortgage by myself.
That's pretty nice.
Yeah.
So because of that, that really, helps build, helps my savings rate a lot. And then on top of that, I'm not one to sacrifice. I'm not one to eat like total, I'm living with roommates and all that. I can make certain sacrifices, but I still like to go out to eat. I still like beer. I still like, having fun. So I don't want to turn into like a prude and just, give up everything just to sacrifice. Yeah. So I like to combine, because I get the benefit of house hacking and all the great savings right there. I do try to focus on my W-2 and also saving, but I know, and when I combine the two, I know, okay, I want to, if I could increase just a little bit more on my W-2, maybe I could buy that investment property, my other goal, a little bit sooner than, especially with 20-25% down. That's a big chunk of change there in the dim market. So any little bit could help versus, eventually, you could only, I'm not going to cut off everything and just make food at home every single day and, sell the car and give up everything just to be that, what a 95%, people say 80-90%, that's a little too. So combine the two and maybe increase certain levers and maybe say, okay, maybe eat out a little bit less, got a little expensive this month. So I track it. I do have my tracking on Mint.com, that app, which is very useful because you kind of see like, oh, I spent, $200 at Chipotle last month. How many times did I eat there? Just a couple burritos. So just seeing that, or like, oh, I just went out for sushi and that was, $190. Like, okay, maybe limit the sushi to every other month or something like that. Just to, I think I look at it more like that, the bigger ticket items, and seeing like, oh, could maybe we go out every other week or so, like for bigger like restaurants or bars and stuff like that.
See, I think the bigger issue with Chris's question is Chris is upset that Jeff looks like he's a 24-year-old strapping young man with a six-pack, and Chris looks like he's 86. So we really, Jeff, need you to start eating out more often so that you don't make Chris and I look so bad.
Jeez, how do you really feel, Joe?
Hopefully everybody's watching the video and the podcast to get to see Chris's face.
I'm trying to think of like polite things I can retort back to you on here.
It'll be in the outtakes, the responses that I get back.
But how do you take on this, Joe? Like, because I've noticed, this is something I noticed about myself the last couple of years, is just when I like try to really tighten up, hey, I'm gonna eat out less here for, hey, save $50 here a week eating out or something here. Like, I go through a mental shift of where like it seems to like impact me on the other side. Hey, I can go out there and use my time and make more money, buy better properties, do like that. And like, hey, the couple dollars saving here, hey, cool, I'm not gonna go buy a brand new Tesla. I'm not gonna go buy these big items, but hey, $50 here. I learned it like kind of mentally shifts for me. And I've noticed like it impacts me on doing bigger things.
Yeah.
how do you balance the, like, hey, saving a few dollars versus, hey, this is not going to honestly move the needle in the grand scheme of things?
Yeah. So I love what Jeff said, that he's not totally becoming like what is it, a monk, right? He's not totally just
Yeah.
hibernating in his house, not eating out, not speaking, right? But he's doing the things that he wants to do. But he has looked at, hey, you know what? The app sort of holds me accountable. And a lot of people ask me for savings advice. Hey, should I cut this out? Should I cut that out? And I say, hey, you need to look at whatever the savings is that you have. And based on that savings, how long is it going to take you to achieve your goal? Right. And if that goal is 3 years away and you really want to achieve that goal in 2 years, okay, great. What are some things that you can cut out that are going to speed up your time to achieve that goal? And then balance that with, you know what? I need some things for my mental health and my mental well-being. Right. So Jeff mentioned, hey, I'm going to go out to sushi and I might spend $150. All right. If we talk to one of the Susie Orman financial gurus on CNBC, she's going to tell you, no, you can't do that. You know what? That's going to keep me from living a miserable life. Sometimes I want to go to sushi. Sometimes I want to spend too much money on sake. Sometimes I just need a break, right? That's okay. And so I think you just need to balance it with an adult perspective of, where are my goals? How quickly am I going to get there? And you know what? We all do really tough jobs. Jeff has a hard job. Chris, you have a hard job. I have a hard job. And sometimes, you know what? I want to spend too much money on sushi because it's going to make me feel better about myself. So I think both of you guys are spot on. Yeah, maybe there's a few things that you can cut out, but don't cut it out for the sake or at the expense of your mental well-being. So I love what Jeff said. He, you know, small, easy, incremental changes. It's going to help him hit his goals sooner, but not make, hopefully, too much of an emotional impact.
No, that's actually, I think the emotional health is something that's not talked about a lot when you're house hacking, because, you know, you're sharing space, you're living, you know, not everyone is comfortable just because you did it in college where you had roommates or live next to people, like, right, like, or even after college in apartments, doesn't mean you're just like it, especially as people, couples and families. And if you have kids, it's like, it gets a little bit harder and more challenging. And, you know, I think emotional well-being is very important. And, you know, if you want to go, you want to have that nice car, like, but you have, and you're house hacking, then I think you have one to balance out another. I think certain luxuries are totally okay as long as you have some asset producing you some income to balance it out and not just a bunch of liabilities.
I think that's such a great point. I see people all the time that have $700, $800, and $900 payments on their BMW and less than $5,000 in the bank, right? I think that's probably a poor financial choice. And yeah, you want that car for your mental health, but at that point, I think that's an overstretch, right? Yep. You've got $50,000, $80,000, $100,000 saved up. You're house hacking, and you're making money on your assets, and then you want to buy a nice BMW. That seems very reasonable. So I think you're exactly right, Jeff.
So last thing I want to talk about in your chapter here, Jeff, is you talked about refinancing your first house hack, which is a fourplex that you bought with an FHA loan, into a conventional investment loan, and possibly getting a HELOC if there's enough equity after the refinance. How did that play out?
Didn't get the HELOC, but I did get out of my FHA into a conventional loan for that property. So I'm really happy. Thanks again, Joe.
Thank you. Yeah.
And, you know, and also lowering the payment. I think I guess I didn't put that part in there too, lowering, because FHA, the big thing that's helpful is it's a great first-time home buyers type lending program, but the mortgage insurance never goes away unless you refinance out of that loan.
Yep.
And that was my goal. And I thought, oh, what a perfect time. You know, let's just see what worst case scenario, just the cost of the appraisal. And fortunately, it came in pretty close to what I told Joe, and was able to get out into new loan and save about $500 a month right there.
Yeah. Yep. That adds up, right? That helps, increases that cash flow, helps you again have that average of these various properties making $1,000 per month or more.
Yeah. That's one thing about real estate is, like, you know, you can't, like, I invest in the stock market and I love it, but you can't do things like that in the stock market where it's, hey, just pay attention, let the equity build, give it 4 years. Hey, interest rates drop. Hey, do some paperwork, spend $700 on the appraisal, and now you're making an extra $500 a month.
Yeah.
Like, it's very hard to do it elsewhere.
I want to add one more comment that this will be my last comment, but I think it was really smart. I think my favorite sentence in your chapter, Jeff, towards the end, you said, to help provide a more diverse investment portfolio along with my real estate investments, I want to embrace my retirement accounts this year. And you talked about putting money in your 401k, putting away, your employer match from your 401k. Do you think that's important for all investors? Should they be diversified, or should we be focusing only on real estate?
Yeah, no, I definitely believe in diversification, and you still focus in on your strong suit too. Some people are really good at stocks, and that's what maybe they should put the majority of their investments in there, and then 20% is real estate. But I love real estate, and I know you guys do too. And I think if you're passionate about it, you're in the market, then the risk isn't the same as someone that is just some investor that has a ton of money and just says, okay, I'm just going to put $2 million and buy a bunch of properties. And like, that's risky. If they, just trusting some property manager take care of it and they never go see it, like to me, that's risky. But if you're in the market, you do your due diligence, you do your research, then real estate and then not putting all your money in there, just because it's good to have multiple investments, multiple different rates of return. So long-term, you're better off. You have a nice solid return and getting the benefits of different types of investments.
Yeah. I thought that was a great point is, hey, you know what? And I don't think this is true in anybody's chapter. I don't think anybody says you should put all of your money into one specific vehicle. I think everybody talks about various places that they're investing money. But I thought that was a great comment. You want to have money in various different buckets, right? Because if one bucket's doing poorly, hopefully another bucket is doing well, or hopefully all of your buckets are doing well at the same time. So I thought that was really smart. Again, just a great, speaks to what a great investor you are and how you're doing things the right way, and it's paying off for you. So love seeing your success.
I got another question that's popped in mind as I was reading that paragraph you highlighted, Joe. You said you invest in S&P index funds. I'm curious, what's your, are you 100% in S&P index funds, or are you doing like 90-10 with bonds? Like, what's your ratio?
Yeah, I'm like 90-10 with bonds. Okay. Just I like that X fund just because I know the long-term return I'll get. I'm not trying to beat the market and say, okay, I'm going the next Apple or Chipotle type stock. I know that's not realistic. Even if I believe I could, there's someone like, I'm not gonna be able to compete with Wall Street anyways. Like, those people spend 24/7, they have teams.
Oh,
and
yeah.
Even if I found that stock, by the time I found it, it'd already be late. And people can always say, oh yeah, if you bought 10 years ago, but you can say that about every single stock like that. Like anyone, right. It's easy to say that right now, but you can't say that. Like, if you knew that, everyone would be a millionaire right now. So.
Yep. Oh, I had one other question that I forgot.
Yeah.
This property, your fourth house hack that you closed on, I mean, the numbers are great. You're getting a cash on cash return greater than 20%. Where'd you guys find that property?
MLS, of course.
Thank you very much. It was on the MLS, 20% cash on cash return. So that's just a reminder for everybody out there. There are still great deals on the MLS.
That's a sweet property. I'm going to go into. We'll do a podcast in the future, but great numbers, great location. 80 on the property. ADU is about the same size as the main house. Like, it's an awesome property.
Yeah.
Cool. Well, Jeff, thank you, man. I appreciate it. You got any final thoughts or updates you want to share before we hit stop?
Yeah. Another benefit or another thing I slightly changed my strategy is utilizing Section 8 a little bit more, especially after this. So on my current fourth house hack, I was like, well, I could rent it to normal tenants, and I offer it out to everybody, but it's totally open to Section 8. And the benefit of Section 8, if people listening don't know, is it's guaranteed income from the federal government or the housing authority locally. The tenants usually pay between 5 to 20% of the gross amount, and then the housing authority covers the rest. So especially right now, people losing their jobs, it's nice to know, well, I'll still get 90% of the rental income if things go sideways. So another way to minimize your risk. as well. Just something that I slightly just thought about more. I was like, yeah, I'll definitely look more into Section 8, and I think it offers a valuable benefit too, because there's so much demand, and a lot of owners unfortunately don't like Section 8 or don't want it. But there's so much people that are on the program that are looking right now.
Yeah,
That's right. Great point.
Yeah. Great final thought. Well, Joe, thank you. Jeff, thank you. I appreciate it, guys.
Yeah. Jeff, always great to see you, man. Look forward to when we can catch up in a non-socially distant manner, but thanks so much for joining us on the call, brother.
Yeah. Thank you. Thank you guys.